Brian Boland, Onu Okebie, welcome to Acquiring Minds.
Thanks for having us.
Hey, Will.
The two of you are building HTL Freight into a leader in the freight brokerage industry. We're going to learn what that is. And of course, the story here, you started modestly with an SBA loan, buying a quite small business with 5 employees. So a key theme to this journey is how to build a roll-up, starting with an SBA loan to buy your platform acquisition. That was also, of course, Brian, the subject of an Acquiring Minds webinar that you co-hosted back in May. We will link to that in the show notes. But let's get to the story. Let's begin with the background on HTL and your partnership and the two of you. How did things come together in the first place? Onu, why don't you take us away?
Yeah, I'll start with my personal background. I'm from Lagos, Nigeria. My family and I moved to the United States when I was 6 with one thing in mind, coming to have the best quality education, to give us an opportunity to have the best chance at life. So fast forward, like my dad, he was a CPA. He was also an entrepreneur. So growing up, all I knew was entrepreneurship and accounting. So I did my undergrad at Georgia Tech with the focus in finance. I also played collegiate football there. Upon graduation, I got my first opportunity in industry working as an accountant for the Home Depot. And I realized quickly that pushing paper wasn't something I wanted to do for the rest of my life. So I quickly pivoted to entrepreneurship by way of happenstance. A friend of mine, his uncle was a truck driver, just got laid off. So I had some money saved up. Saw it as a business opportunity and, asked him to be my driver. And he taught me everything I knew about the logistics industry. So fast forward, we grew that business. We did well. We had some contracts with some key customers, and we ended up exiting that business. I got back into industry, working back in finance. And the company, what they did was they sold Class 8 trucks and parts and services. They were doing north of $200 million in top line revenue. And that company got purchased by a private equity firm. And I was close in getting that transaction over the line. So that was my first real exposure to structured finance and M&A. So I realized this is what I want to do. Actually, I want to get into the deal-making business. So I decided to go back to school. I enrolled at Better Business School to focus and study M&A. The intent was to graduate and go work for a big private equity fund or investment bank. But that didn't work out the way I thought it would, which that was a blessing in disguise. Had a course in EPE, partnered with Brian Boland, who's also our CFO. And, we set out to go do M&A deals ourselves. So I remember, we called an emergency meeting, December in 2018. And, we said, hey, we don't have to go work for a big investment bank or private equity fund. We can do deals ourselves. And 2 months later, we were on the plane, sitting across from a potential seller trying to buy their business. It took us about 2.5 years to find the right deal. We wanted to transact, but we wanted to make sure that we're transacting with the right people, with the right partners. So it took us some time to find that right opportunity. And fast forward, we did our first acquisition in 2021, and we've done 5 acquisitions to date. So we are growing a platform called HTL. We have a brokerage division. We also have a managed services division. And what we do is we help manufacturers and distributors move their products from point A to point B, cheaper, faster, and more efficient.
That was great. Thank you, Onu. And Brian, I'm going to want to hear from you, but a couple quick follow-ups, Onu. An emergency meeting. So were you guys already partnered? What do you mean you called an emergency meeting? In what capacity?
Very good question. So we were in the same classroom, we had the same cohort in business school. So we, me and Brian, we weren't the best of friends in business school, but we had shared interests. We were both entrepreneurial and we both like taking risk, and we didn't think the corporate world was where we wanted to spend the rest of our lives. So we had the shared interest. So we became relatively close in just talking about what we want to accomplish post MBA program. So we had the same class, the EPE class, the entrepreneurship through acquisition class. And I remember it was like yesterday. It was like it was a key class. It was a key session that just lit a light bulb in our heads. And we looked at each other, and I went home, I thought about it, and then I sent the text and said, hey, let's meet at my house and let's have a conversation. I think there's an opportunity here. So he came, and we talked about potentially going out to do this thing ourselves. And I said, hey, like, there's this website called Biz by Sell where you have an opportunity to go out and find businesses. And we were just amazed to see the plethora of businesses in different industries all on this website that are looking for new owners. So that was the start. And it sounded good to him, and we were off to the races. Myself and Brian, we have a bias towards action. So like I said, 2 months later, we're literally on the plane. We were still in school, by the way. And I think, we got the flight to New Jersey, and we had class like on Monday or something like that. It was something ridiculous, but we flew up to New Jersey. We had a conversation with the potential seller. First conversation with a seller, like, we didn't know what the hell we were doing. But I guess you call it fake it so you'll make it. But it was a good conversation, and we continue getting reps, and we just continue filling up the pipeline for potential acquisition targets.
Great. And you said that your exposure to an acquisition in your earlier career turned you on to the idea of doing deals, and you knew that was the path you wanted to go down. What about doing deals turned you on so much? And yeah.
Well, really, it was the economics of it, right? So it was a family business that it was, I think, 3 generations, and they were looking for growth capital. And like I said, I was involved in getting the deal across the line, but I saw their economic outcome for exiting their business, and it wasn't 100% buyout; it was a partial buyout. So seeing the economic prowess there really, got my attention. And I started talking to people in the space. I have some family members, I have friends that are in private equity, so I started having conversations with them about that. And they, mentioned it was really lucrative, especially if you're in the right space. So like that's the reason why I wanted to go work for a private equity firm, right? But again, everything happens for a reason, and I'm glad I didn't get an opportunity to go work for a private equity firm, because the better economics are when you actually own the company outright,
right?
Versus being an independent sponsor or what have you. So like that was where that came about.
It's funny that there's a pattern that shows up on this podcast where people working in private equity will see a transaction, or be around the table of a transaction and see where the real dollars, where the center of gravity of those dollars really is, and it's in the owner of the business. It's not actually the principals of the private equity firm, and it'll be that epiphany that makes them want to go out and build a business, leave private equity, and go and be the operator or owner, because as much money as you can make in private equity, it seems like the real smartest ones in the room are the ones getting paid, who are the owners.
Yeah. And I like getting my hands dirty, right? And doing, acquiring a business and being an operator was something that was also appealing to me, right? Like myself and Brian, like we have that, like I said before, bias to action, and we want to get our hands dirty, want to roll our sleeves up and actually add value, right? We just don't want to be the guys that fund the deal and we're in the background, on the board, waiting for a quarterly report on every 90 days. We wanted to be actively involved. We wanted to roll our sleeves up, and we wanted to add value to the actual businesses that we're buying.
Great. Brian Boland, get in here. Let's hear your side of events.
Some great memories there, Will. Yeah, so my background, I'm Brian Boland, originally from Ireland, a small town called Tullamore. where Tullamore Dew whiskey is distilled, about an hour west of Dublin in Ireland. Spent the first 17 years of my life there, and then 10 years in Dublin, where I went to Dublin City University, played some collegiate golf, with some much more talented folks than myself, but was maximizing my potential just to be on the team. As a walk-on, majoring in accounting and finance at Dublin City University. From there, we worked with KPMG in Dublin, in the consulting arm, and then worked for a big building materials company called CRH PLC in Dublin for 4 years, and they sent me to Atlanta in 2012. So been in the US now 13 years. Worked for CRH there in a number of different roles across the finance function. Did my MBA at Cosweda University with Onu in 17 through 19. I had come originally from a family of entrepreneurs. And my parents and grandparents were entrepreneurs. So I'd been around that a lot. And a lot of my parents hadn't had a traditional education, so they always promoted going to college and getting the best education and doing as much as you could before stepping into that entrepreneurship. So by the time I felt I had maximized all my learnings, I learned a ton at consulting and learned a ton at CRH. They went around buying legacy family businesses in a very fragmented space in the building materials world. So learned a ton there about the financial discipline through M&A and how that could be successfully rolled up. And it was when I sat in that entrepreneurship through acquisition class at Emory, at the famous entrepreneurial private equity with Klaas Baks and David Panton, 20 minutes into the class, I was like, this is what I am going to do. I cannot believe you can flip the 90% risk of failing as a startup and flip it into 90% success if you just manage the free cash flow appropriately. So I immediately was very attracted to the proposition, and Onu mentioned, we gelled from mutual interests. We both interested in the entrepreneurship world. We both liked the ETM model, and we both had logistics experience. He had it on the carrier side. I had it on the customer side. We had that collegiate sports background, that competitiveness, the bias to action. And then just most importantly, we had very shared values, very similar values in life, very family focused, very goal orientated. And I think, we spent, within a few weeks of working together. I remember when Onu called that meeting, I had a very busy Saturday when he called that meeting late Friday night, and I rescheduled a lot of things to be there because it was like, this is the conversation I feel like I need to hear, and the rest is history, as they say.
I love the emergency meeting, Onu, and really that was just a text to some buddies or to a buddy. I'm going to use that in life. I wanted to underline something you said, Onu, about your discovery of biz buy sell. I've said this before, but biz buy sell can get beat up on a little bit. It's not the most modern site. It's been around forever, but it does the trick, and it is the aha moment for many people in this world. If you haven't seen it before and you don't realize this universe of businesses for sale that owners are looking for you to buy them exists, biz buy sell can provide that aha moment, and it's really
it's really mind blowing.
Yeah, it's really neat.
Get you started, Will. It gets you momentum, points on the board, right? I think we've evolved significantly since then, but you have to have those started moments, right? You have to start somewhere, and then you evolve from there.
Well, let's hear now about getting started. Onu, you mentioned your trucking business, I guess traditional trucking, like you had a truck driver who was working for you, and you touched on logistics. We know that you guys are in a logistics business now. So was this a thesis-driven project from the get-go, or what? How did the business that you're in, the industry that you're in, what you're building today, how did that come to be?
Good question. And like I said, it took us 2.5 years to find the right deal. And I would say when we first got started, like we knew we wanted to stay in logistics and transportation in some capacity. We weren't as focused to start. Like we were looking at warehousing, we're looking at asset-based companies, we're looking at third parties. So like it was a very broad-based search within that industry. But as time went on, like we found it more beneficial to focus in a specific niche, in a specific space, which was non-asset third parties. So like once we honed in on that, our success, we became a lot more successful in finding like the right opportunities versus just having more of a broad-based search. So to answer your question, it was a thesis within logistics and supply chain, but we didn't really focus in on the non-asset side until later on in our search.
So you knew you were going to do logistics because you guys had this experience in logistics.
Correct.
Yeah. And also it was, I guess, pretty fragmented. There must have been also characteristics of, it's an enormous category, but characteristics of this whole category that you liked? Or was it just the fact that it's what you knew?
It's what we knew, but it's ripe for what we were trying to accomplish, which was do multiple acquisitions within the space, right? To your point, it's very fragmented. A lot of small players. Nobody really has a lot of scale except for maybe 3 or 4 organizations within the space. So we felt, with our operational background and using an M&A strategy, we can get scale relatively quickly by going into this space.
Great. Brian, did you want to add something? Oh.
Yeah, I think Onu covered it very well, Will. We evolved the thesis as we went. We narrowed down to logistics. COVID happened in the middle of our search time, so that made us very, very micro-focused. We had the opportunity to do some really good industry analysis around what worked well in COVID type cycles where you had economic disruption, and focusing on areas that you knew really, really well was important coming out of that research that we did. We had some interns working with us, so that was a crucially important point. So we got a search-focused logistics firm to help support us. We just went very micro. And as we evolved from there, we continued to become more micro-focused. And be, it allowed us to be very good competitively in such a micro-focused space. And that's just a common theme in our story.
Yeah. And great. I'll want to hear about that. But first, tell me what the kind of final super dialed in thesis was. Explain that thesis and kind of what you saw the opportunity to be, the industry dynamics that gave you this opportunity.
Yeah, typically logistics, it's like I said, it's a very wide industry, but there's lots of different niche areas of logistics. So there's like moving companies are a niche area of logistics, not our area, but it's a totally independent area of logistics. There's areas of logistics that move heavy equipment. There's areas of logistics that move commodities. They move frozen foods. They move LTL packages. There's all sorts of different dynamics. So our initial focus was to acquire into a specific niche. Something that had a defendable niche. Those are typically higher margin, and an area of the business that was more harder to step into or to start up. Typically, anyone can start up a freight brokerage tomorrow, right, and start to price out commoditized types of freight. But our entry points, and it's difficult, right? You got to acquire customers, and you don't want to be the lowest price in the market. But we were very intentional on picking very, very niche businesses that had a niche knowledge. So our initial acquisition was in the flatbed industry. It's a very niche area of freight. It moves building materials and oversized type products. So it's typically higher margin. It's typically more expertise. Our initial thesis was to build a portfolio of flatbed brokerages from there, and we found that was just incredibly hard to find that specific niche again. But what we learned as we looked for more acquisitions was there was tons of different niches that we could acquire into, and there was a lot larger pipeline around that. So the thesis then evolved to acquire into these different niche areas, acquire all this expertise in that niche, and then scale that to a full service firm. And that's essentially what we did. We bought 5 different niches in the 5 different acquisitions. Each different one tucked in another area of expertise and expertise, staff expertise in that space, carrier networks in that space, customer relationships in that space, and then we've been able to get some synergies and a lot of cross-selling opportunities within that. So it's a very unique thesis that where we ended up, but it's certainly evolved on the way. I always tell people Amazon started as a book company, and we know where they are now. So you start with a thesis and evolve from there, and I would say it continuously evolves. But those niche areas have been very very attractive to us as we've built out the portfolio.
And so these series of acquisitions that you've done, just to make sure I got it, have added service lines essentially, so that now you have, as you put it, a full suite. You're kind of a full suite solution. You can offer multiple services to your same customer set, so you've got cross-selling, upselling, and you become kind of more of a single point.
One-stop shop, right?
Well, thank you. Exactly.
Yeah.
You become a one-stop shop.
Yeah. So we do full truckload, LTL, drayage, hazmat, the whole 9 yards. So the thesis has evolved to Brian's point. And I think generally speaking in business, it's you have to go in and test and see if it works. And you can't be too rigid, and you have to be able to pivot when needed. And to piggyback on what Brian was saying earlier, initially we wanted to be the biggest flatbed brokerage in the United States, but we found it very difficult to find other flatbed specific third parties to go acquire.
Mm-hmm. Well,
one other thing to add, Will, on the geographically diverse as well, it was important to us, so that we had lanes and we had carrier networks in different parts of the country. So we've been intentional we've done 2 deals in North Carolina, we've done one in the Northeast, we've done one in Chicago, and we've done one on the West Coast. So it's been important to have geographical diversity as well from a logistics perspective, to have stuff going out of the Northeast, stuff going out of North Carolina, but also coming into North Carolina and then going west to East Coast. So that's been an important part of that as well.
Great. Well, one thing that struck me from the pre-call from your story, guys, is that you did have a rather long search. Partly was that COVID happened in the middle of it, but it was a 2-ish year search. In the business that you ended up with, your platform, as I said at the top, is actually quite small. So it's a little counterintuitive, because you'd think for people searching, they're looking for what they finally end up closing on is going to be, $1.5 million of SDE or something. But this business doesn't. It felt like it was pretty small, and therefore I would have thought maybe not so rare. So why was it the needle in the haystack that you've been looking for?
So for us, we've bootstrapped this thing between me, Brian, and we have a third partner. This has been 100% bootstrapped. So we didn't raise capital until our 4th deal. So consequently, the first deal, it was literally like our personal assets that we had to bring to the table to get the deal closed, right? So in order for us to accomplish that and retain 100% of the ownership on the outset, we needed to use our financing that we personally raised, from our bank accounts to close the deal. So we started off small for that reason.
Can you share kind of what your budget was for that first deal?
Oh man, it's 5 deals. That seems like so long ago, but it was I think it was a $1.5 million transaction.
Okay,
yeah.
If memory serves me.
Yeah, and we had the ability to go higher than that, Will, if we needed to, because there was an element of opportunistic nature of what the deal came up in the ranges. So we had looked at acquiring capital as well. We'd looked at raising capital. It was just expensive for rookie entrepreneurs, right? And that makes sense, right? When you didn't have a track record. So to Onu's point, we made the decision that if we can find a deal in that right sweet spot of range where we can have 100% of the equity and build a track record, that the equity will become a lot cheaper over time. And that worked out as expected. Once we were able to show a 3-year track record and three deals, we were able to raise on totally different terms than we would have starting out. So that was a focus, but the right deal has to be there within that range too. And I think we were very patient to find a really good platform in the right range where we could retain 100% ownership and roll the dice post acquisition.
This point about equity becoming less expensive as you build is such a good one, Brian. And for finance people, it may be self-evident, but for the non-finance people, it's just kind of theoretical numbers here. If you had raised equity going into the project, unproven, without even your first acquisition, or trying to get your first acquisition done with some outside equity, maybe you would have given up 20, 30% of the business, maybe more. And for not very much, for, maybe, $100,000, $200,000 effectively that the investor was giving you. And instead, you, now when I don't know, you probably can't tell us how much equity your outside investors own of the business. But you basically sold it you got a lot more cash in exchange for a percentage that might be directionally similar to what it would have otherwise been in my theoretical example. How did I do it explaining that?
Yes,
That felt like
really good.
I
Well,
get there?
I mean, you think about it, like what we raised eventually after 3 deals was probably close to 10 times what we could have raised at the start for the same equity dilution.
Thank you. Much cleaner.
Because
Yeah.
there was just so much value put on the track record. And you had 3 years of financial statements, you had 3 acquisitions behind you, you were used to it, and the track record was there. So, investors get a lot more comfortable in that situation. So yeah, it's totally different. But there is a track record there, right? And investors realize how hard operating a small business is, and it is hard. and all your skills are tested, and you have to develop more skills. And it's great to be able to do it with a partner that has different skills and is running at the same pace. But investors really value that the ability to do that because it is hard.
Well, but this thing about raising money at the outset versus later when you're proven, and you basically raise money for a tenth the price of what you otherwise would have. I just don't hear. I haven't heard that from other self-funded searchers. It's so logical. So it's just a really good call out for people to understand and think about themselves. Of course, a lot of this presupposed that you were going to be building aggressively and doing a consolidation play, right? So maybe for the self-funded searcher who's just trying to get into a single business and, who knows what after that, it may not be as much of a factor, but you guys were full throttle, big vision from day one, right?
Yeah, 100%.
Yeah.
And just from a principles perspective, we weren't 100% comfortable raising money and putting investors' cash at stake without, proving the thesis and proving what we wanted to go out there and do, right? So for us, it's if this didn't work out, we were on the hook, right? But we didn't want a situation where it didn't work out and we had investors' capital on the hook as well, and that can burn bridges for forever, right? So we wanted to come out, get a track record, and prove the thesis that it works, and it does work.
Great. Okay, so this business that you found, what about it did you like so much? Why was this the one? Or tell us about the business, please. Specifics about it.
Okay. Specifics about the business from a geography perspective, it was because myself and Brian, we were originally in Atlanta, Georgia. So North Carolina, Charlotte, North Carolina specifically, it was close to home. So like for us, when we first, did the deal, we were commuting back and forth for a year, right? So like literally, like we had a consultant lifestyle. We'll, drive up on Sunday and we'll head back to Atlanta on Friday, right? So from a geography perspective, it made sense.
Wait, sorry, Onu. That doesn't sound close to home. That sounds far from home.
Well, it's better than Minnesota, right?
Okay.
It's better than doing a deal in New Jersey. It's better than doing a deal in on the West Coast. So it was driving distance, right? It was driving distance. And if my wife called me and said, "Hey, we have an emergency," I can get in the car and be home in 3.5, 4 hours.
Okay. Great.
And also, this deal that we got, there is again a small business, $500,000 in EBITDA. It had some hair on it. It was an owner with 2-3 other people, right? So it was he had a job. So like for us, it was small enough and it had enough hair on it, and we knew exactly what to do to increase value immediately in a business. They were very, very archaic from a process perspective. Literally were still using pen and paper for everything, right? Like they had stacks and stacks and stacks of paper everywhere. It took them, 30, 40 minutes just to set up a vendor in the system. We came in and we turned that from, 30, 40 minutes to 30 seconds, right? So we're able to incrementally build customer service and use value within the organization relatively quickly. And another thing that a lot of people skirt over is the working capital opportunity within the business, right? A lot of small businesses, they're receiving their receivables in 30 days, but they're paying their vendors in 10 days. So there's a huge working capital benefit there if you can right size that formula. So we saw that opportunity early on, and Brian, he's always on that, right? Once he sees a working capital opportunity, it seems like a great deal for us because we're able to get that cash on the balance sheet and invest more in the business.
Excellent. Working capital is a theme that comes up time and time again. It's such an important feature of small businesses. It's so often misunderstood. Sounds like you guys understood it really well. Can you be more specific about how you change the payment terms, both money coming in and going out, to your advantage?
Sure.
Yeah, I can touch on that, Onu.
Go ahead.
There's a really good case study actually out there, Will, on from Yale on this that I read subsequently after doing a couple of deals to help fine tune this. But essentially, it talks about stress testing both sides of that. So on the AR side, getting invoicing out as quickly as you can, offering small discounts for early payment where possible, having regular collection checks, and figuring out, staying in close contact with your customers on those dynamics. But really on the payable side is where I've found that's there's typically in freight, you've got a wide range of payables. You've got tons of large carriers, small carriers. There's factor companies are quite popular in the space. And all of those different vendors have different payment needs and payment requirements. So typically stress testing the payment days, adjusting them over time, gradually changing them over time, evolving from checks to electronic. We're all electronic now, but we'd inherited a legacy business that had a lot of paper. So there's lots of different dynamics around that. But when we saw the working capital opportunity in the deal, and we also made sure we got an express line of credit with the SBA loan, like that was then a lot of liquidity to go and do another deal. It was more liquidity than we had at the start, right? Even by the time we got through all that. So it allowed us to get velocity and do another deal within 9 months. But working capital execution is like it's like hand-to-hand combat, right? It's hard yards on the ground. It is working through the specific details of each vendor, researching the vendors on their size, understanding their payment dynamics, and stress testing how far you can press that, and optimizing it right at the optimal line, right before they're reaching out. You've got them paid. And on the AR side, just getting to an invoicing position as quickly as possible and making sure that you're motivating employees to do that at scale. So when we started out, we had a lot less velocity of amount of loads. We've got over 10x the amount of loads now. So even at this level, it's nearly a daily focus on the working capital and staying on top of guys and making sure that there's no log jams in the process, and that working capital is as optimal as possible. And then as you evolve and you work with a bank in the industry, you've got a line of credit with a bank in the industry, and you're reporting to them and you're reporting against competitors. I mean, we have our bank come back to us all the time to say how far ahead of our competitors we are in our reporting and our working capital metrics. So, and I always tell the staff that, and it gets them very excited. So it's there's no classes on working capital in school, right? There's very limited information out there. The Yale case study is probably one of the best I've seen that's been done on it. It's probably one of the single most important dynamics of small business, and so many people go into deals not understanding it. So I'm hoping in a future life I can maybe give back on this topic, because I feel it's so important. And where that, if you don't know the working capital dynamics of your space, you can get post-acquisition in trouble quickly because you don't have many liquidity options, for a little bit of time after you do this. Right now, luckily it was a focus for us going in, but I see many folks with lack of focus on that, and it's a very important component.
Well, and of course, working capital matters more in some industries than in others, and in yours, it matters a lot. Maybe now would be a good time to track a dollar through your business to really understand what freight brokerage is, please.
Yeah. So if we take it from the top, you have manufacturers and distributors that want to move their widgets from point A to point B, right? A lot of those manufacturers and distributors, their core competency is manufacturing products and distributing products, right? It's not transportation. 96% of the carrier base trucking companies in the United States are small mom and pops, right? So you have 5 trucks or less. Those manufacturers and distributors don't want to work with 100 different trucking companies. So what they do is they partner with a company like us that acts as that intermediary, and we facilitate everything. So a customer would call and say, hey, HTL, we need a full truckload of XYZ moved from X to Y, right? We will now reach into our carrier network and connect the right carrier for that shipment, right? So we're a matchmaking service, right? So the shipper, we negotiate $1,000 for a particular shipment. We negotiate with the carrier to move it for $900. And as the intermediary, we keep the margin, which is $100 for our services.
Mm-hmm. And the carriers that you're using to get your customers' widgets from point A to point B are third parties, but really they're not well, I guess they are subs, but the point is that spread, that $100 that you're taking, you're responsible ultimately for the widget. You're not just a middleman. You're really the service provider. You just happen to be outsourcing the actual transportation.
Correct.
Yeah. And so, I would have, please.
And like I said earlier in the call, we have 2 lines of businesses. We have the brokerage business and we have the managed services business. So the managed services business, we're look at us like supply chain consultants, right? So we partner with shippers to help streamline their supply chain, transportation logistics, because a lot of manufacturers and distributors, they don't look at transportation logistics as a competitive advantage. Well, we do. We think it should and is a competitive advantage for a lot of the manufacturers and shippers out there. So what we do is we partner with them to unlock the competitive advantage by, helping them move their products cheaper, faster, more efficient, right? So we dive deep because most of the time when there's an issue from a transportation perspective, there's something, upstream that happened that caused that issue, right? So maybe a manufacturing line was down and it was late, so now we have to get a trucking company to move it just in time, right? Which increases cost, right? So we're able to dive in deep with the customer to assess those issues that might be happening within their four walls that may not have anything to do with transportation and logistics. So that's the other side of the business that we also own and operate.
And how does that break down in terms of percentage revenue, the consulting versus the actual brokerage?
It's about 80-20, Will. So about 80% of our business is brokerage and about 20 is consulting. We've acquired 5 brokerages, and one of those brokerage had a big managed services business. So, but there's a lot of opportunity for growth in the managed services. It's actually quite an attractive area in the industry because even though it's consulting, it tends to recur quite a lot because you tend to be helping them through problems, and you tend to get contracts for a number of years. So it's actually a very interesting segment in the space, and something that we see a lot of growth opportunities in.
Yeah. As consultant, we're implementing technology within their ecosystem. We're augmenting their labor. It's really spans the gamut from a support perspective.
Guys, back to the freight brokerage business. This seems like the sort of industry dynamic that lends itself well to a winner-take-all online platform. That is, 25 years ago, there would have been some tech platform that allows manufacturers to put up jobs and mom and pops to grab them and to cut out guys like you. It doesn't exist?
It's been tried multiple times. Convoy was a huge example there. And they were in financial distress, and I believe they were financial distress, but they were sold off. Uber Freight, that's another one that tried the digital brokerage deal where we have a platform and we effectively are a marketplace for shippers and carriers.
Yeah.
But the big thing and the big unlock as to why that model is difficult to execute, because there's a huge service component that's missing with a marketplace like that, right? Customers still want to talk to their dedicated account executive. Hey, what's happening with this? So that's the big piece that has been missing from that side. So like we don't believe the digital marketplace. And again, like there's some customers that like that model, but the vast majority of the customers out in the United States, from our experience, they want that service and they want that human to human touch.
Especially in the niche areas. Well, like we're focused on niche areas. We're not moving commodity type freight that's, anybody can move. You're moving complicated stuff. You're working at the port on drayage loads. You're working on complicated machinery. You're working on refrigerated, frozen type products that are time sensitive. All of that, most of the time, the customer wants to make sure that arrives at their customer in a timely manner, right? So they want to make sure they're maintaining their customer relationships. And if it's just handed off to anybody at the lowest price, most of them have tried that, and the service level is just not there. So we tend to not come up against that a whole lot, just by the nature of the freight that we're moving. And we feel that the nature of the freight that we're moving, it's going to be very late in the process before they're one of the last dynamics. We have a good digital platform, but there's just a huge customer service element that we don't feel is going away anytime soon.
Great, guys. Okay, I'd like to, we're not going to have time to go to hear the story of every acquisition. So let's just do it this way. Let's hear a little bit more about what you did on the other side of your first acquisition. We've heard that Brian really optimized working capital, and I guess he never stopped. He continues to do that. What else did you do in that first acquisition? And then we'll quickly go through all the 4 others that you've made.
Yeah. So the first one, it was streamlining operations, right? So like
digitizing.
I mentioned, just putting together a proper transportation management system. Like the old system that they had was literally an access database that only accommodated one person in the system at one time, right? So as you can't scale that, right? As you have multiple people in the system. So we upgraded the technology suite. We professionalized the business. We implemented simple things like monthly business reviews with our customers, right? Like just little things that we added that, kept the customer happy and created more of a tighter relationship with us and the customer. Like a lot of small businesses, they like to work with the whoever it is that they're receiving the freight from, right? Like the logistics coordinator, et cetera, et cetera. But what we did was we wanted to take the relationships up a notch. So we were going to the director level, VP level, those as executives, because like that's where the relationships are formed, and that's where you can really drive strategic momentum forward in getting more business across those organizations. So for us, it was the little things that a lot of these small businesses don't do on the outset that we focused on. We're not splitting atoms here, right? It's the basics, and we came in and we did the basics, and we were able to reap the benefits from it.
Hey guys, you said it was $500,000 of SDE, so your SBA loan probably ate up half of that. So you have 250, call it, of earnings to split between the two of you and reinvest in the business. What did kind of earnings and cash look like in that first year or two? Were you just basically putting everything back into the business? Were you paying yourselves full salaries? What did that look like? Because you're building a platform for a roll up, but without much oxygen. So how did you manage that?
Yeah, well, I mean, certainly the first year or so was definitely tight. We took pay cuts to do it, and we were happy to do that. There was talk about only one of us going into the operations, and we had a conversation, and both of us wanted to go in. So we just said, okay, we're both willing to sacrifice what we needed to do that, because we both wanted to be in the operations. You're doing an SBA loan, you're signing a personal guarantee, right? We were both like, we're going to be on the ground and we're going to make sure that this works. So we were commuting to Charlotte. We had an apartment in downtown Charlotte during the week that we stayed in. We took pay cuts the first year to do it. We did have, a nice working capital coming through the business. So we had a little bit of a buffer the first year, and within 9 months, we were able to do another deal to give us a lot more space. When we did that without the need for any external capital, we were able to do that with cash that we we had generated from the business and a seller note. So we were able to size up quite quickly. But yeah, those first 9-10 months were certainly relatively tight. But that's most entrepreneurs, experience that. And there's all the hard yards that we're doing. But I think without doing that, like the velocity of the two of us on the ground, Onu focused on the operations. I was focused on the back office and digitizing that piece of it, and focused on M&A and focused on cash flow generation. So just the velocity and speed that we were able to move with two of us on the ground just paid absolute dividends during that period of time.
Brian, you said that those first 9 or 10 months were tight, but around that time, or and just thereafter, you actually, because of the working capital and just more cash coming through the business, you had enough cash on the balance sheet to then be the equity plus the seller note, enough equity plus the seller note to buy a second business and much bigger business, or a bigger business? Did I hear that right?
About the same size. Well, so if you think about it, we had an SBA Express line of credit going into the deal. So we had a cushion there that we wanted to make sure that we had, given the two of us were going in at the size. And we also had a working capital opportunity that we knew was significant. So, between the working capital opportunity, we were able to put free cash flow on the balance sheet. We had the SBA line of credit. So when you put both of those together, we actually had significantly more equity to put down on the second deal than we did on the first. If you think about it, the way the SBA is normally structured, you only need to bring 10% usually. So we actually had a nice bit of firepower to go and do another deal. And so we were able to leverage that with a down payment and a seller note over a period of time to acquire that business. So we were able to nearly double up in size within 10 months. And that gave us quite a nice cushion from a cash flow perspective. And we still retain some of that cushion that we had. So that gave us a lot more room in after 9 or 10 months. And then with that cash flow, we were able to generate and do another deal about 9 months after that. So within 18 months, we'd done 2 more, all from cash in the balance sheet. And we leveraged an SBA loan for the third one because we were in a position to do that. So we were able to, it was very important that free cash flow generation that we got early in the process, having that cushion, allowed us to be able to do that second deal in a short period of time.
Yeah, and that was faster than you expected. I assume you weren't thinking that you'd have 300 acquisitions under your belt in the first 18 months, or maybe you did.
And it probably was faster than we expected. Like, we had a thesis, but we had to go in and figure it out, and it kind of became opportunistic. We had someone in the space, a coach that was working with us that was specific to the space, and he had someone in his network, and they were in an acquisition process, and he thought an introduction would be helpful right in the middle of that process. And we were able to beat out the other vendor in that process. Just we had a very good relationship very quickly. He liked us, we liked him, and it was really, really, really good fit. And all the deals subsequently came through, normally through those industry type connections. It's just so much easier to do deals when you're in the space.
Yeah, absolutely.
And people, it's easier to have those conversations with owner operators because you have a business and you're operating a business.
Absolutely.
And you immediately bond on that.
Absolutely. It's such an important pattern that comes up again and again. And what about so financially, we understand how you pulled it off, but what about just like the, your attention span, your ability to juggle a second and then third business? How did you think about that? Because it feels like you probably hadn't even finished digesting that first acquisition. Just move fast and break things, sort of thing.
Well, the collegiate sports helps here, Will. Like, you move, you have muscle memory to move quite quickly in that space. So the discipline and speed of collegiate sports, I think, helps. Onu has some very good habits, and they rubbed off on me too. That helped as well. So you could, we could tell stories about getting up at leaving for the office at 7, getting back at 9, and then going to the gym at 9 o'clock at night, and then doing the same thing again for 4 days when we're driving home on Friday. So it was all business. We were at the stages in our lives, young families, a level of maturity that was more mature than earlier stages in life, and it was just all business. And we were able to operate at that speed together. I think the folks around us struggled with that. People in small businesses that were not used to that speed really struggled with that. And we noticed that having more people to be able to operate at the speed that we like to operate. We've got more collegiate sports background folks in the organization now, which really helps. So I think we were tag teaming it really, really well. where it was relatively comfortable, but you're talking to folks that are used to operating at that speed.
Mm-hmm.
Yeah, it's the acquisition, like the second acquisition was very opportunistic. Again, it was just knowing the right person and the right time, right? The stars aligned. And when those type of opportunities come along, like you have to seize it, right? We could have said, hey, like we're not done perfecting this yet, so let's wait, and that opportunity never comes around again. So again, it's we had our mind set on we're going to grow this thing as big as we can get it. And we were eating, breathing the business, right? So we were moving at a very, very fast pace. And to Brian's point, like the biggest challenge is currently bringing the people along on the trajectory that you're going. Because if you think about it, like most small businesses, especially at that level, it's typically a lifestyle business, right? So, within the business, the previous owner, they have a certain lifestyle, they're comfortable. The employees are relatively comfortable. Some might want more, but the vast majority of them are just good where it is. So when you have two young guys coming in and we're talking about growth, I mean, that could be intimidating for some. But for us, I mean, I think like what's been incredibly, fulfilling for us is to see a lot of the folks that we, like the initial acquisitions, to see that they have rose up in the ranks within the organization, and they're able to grab the bull by the horn and keep up at the pace that we're going. And they've been rewarded, with that mentality and their dedication to the organization.
That's a great point there. I mean, a lot of folks, we didn't necessarily do it for the value that gives you, but like seeing people grow and able to see their careers develop, responsibilities develop, income increase along with what we're doing. It's very rewarding and very fulfilling. And I don't think, you start out without that goal, but that becomes a super important part of it. And why you enjoy it so much is you see those folks grow. Very fulfilling, very, very fulfilling part of the journey.
Mm-hmm. Mm-hmm. It's funny, Brian. I've heard that pattern many times, that business buyers don't realize the gratification that's going to come from the relationship to employees. It's not why they do this, but it ends up being one of the most gratifying aspects of this journey. I did hear you guys say on the pre-call, though, that despite the collegiate athletics background or whatever, that you've had to stretch yourselves, that you've grown a lot as people. Say more about your personal journeys here, your own growth journeys.
Well, yeah, it's certainly has been a stretch. It's the first time we did an acquisition, right? So that was a first. There've been multiple firsts, right? And anytime you hit a first, you have to adjust as a person. The CEO I am today, it's something different is required of me today than it was 4 years ago, because we're just a smaller business. Now we have 70 employees across the United States. We have satellite office in Medellin, Colombia. So it requires a different person, right? So by extension, we all, myself and Brian, had to grow personally. Because if we didn't, then the business wouldn't grow. And as we continue to grow ourselves, then we keep on elevating the business over and over and over again. But frankly speaking, a lot of it is by force, because as we're going to continue growing, and as we get bigger, we have bigger issues that come up that we have to solve for, right? So we're always thinking about like, how do we upgrade? How do we upgrade our people? How do we upgrade our networks? How do we upgrade our systems, et cetera, because everybody has to elevate in order for us to get to the next level.
Yeah,
what about you, Brian?
Onu brings up some great points. I think you become a lot more disciplined. In order to get more out of your day, you've got to be a lot more focused. Areas that you have to be an expert in, and you have to know areas you don't know, and getting the right experts around you. Our level of consultants and vendors is just at a different level now than it's been at the start. You make a lot more healthy choices because Onu made the point, you're forced to, right? You eat better food, you don't eat certain food, you exercise regularly, you just stay on top of yourself. You got to manage your time better, a lot more demands on your time, with trying to get on your calendar. So it becomes a level of discipline that becomes forced upon you, but I think it helps make you a better leader, and a better example to your team. And we've got young families at home that at the end of a long day, whether it's a long day in business or a long day on the road, they require and deserve your energy when you get home.
Yeah.
So you have to make sure that you leave as much room in the tank for that as you leave on the field in the business day. So to be able to do something like this just requires a growth mindset. And I think, I've been very fortunate to find a business partner that has a growth mindset on a daily basis. And I think we feed off each other as well. And we both have whoops on our arm now, measuring our recovery performance and our whoop age. I'm down to 39.5 years, Will. So I'm very happy with that, back under 40 again. But if the whoop is good enough for Ronaldo and Rory McIlroy, like it's good, and Patrick Mahomes, it's good enough for us. So those types of dynamics, again, we build momentum off each other on the healthy lifestyles, and that helps on the leadership styles, and just helps with everything that we're trying to achieve.
Onu, when I was Googling both of you for your LinkedIn's, et cetera, I found your Instagram, and you have a reel talking about being bad at something for a period of time, and needing to be comfortable with being bad at things.
Yeah.
As part for somebody who wants to grow. Say more about your philosophy there.
Well, kudos to you for investigating and searching the Instagram. But no, I think that's an incredibly important topic, because in order to be good at anything, you have to be bad first. And I believe a lot of us never get great at anything because we don't want to be bad first. Right. So for me, I have to work on this. Right. But for me is putting myself in situations that I may not be the best at, but, just getting those reps. And it might be bad. It might not look good, but it's going to get me to the point where I'm great at something. Right. The first, meeting we had in New Jersey with the first potential acquisition target, it wasn't the best call, right? But as we got reps, so I'll consider us bad on that first call, but we got more reps, and we would prep so much for these calls. And year and a half, 2 years, is we would have a call and we would get on a call with no prep because we just got good at it. Right.
Mm-hmm.
So it's always getting the reps and being comfortable being bad, and not letting being bad stop you from moving forward.
Yeah. It's so simple, but I love it. It's such an important message, because I think, I think the key part of the message is that you might not even realize it, but because you're afraid of being bad at something, you don't even attempt it. And so
Yep.
you're creating limits around yourself, and subconsciously, and you might not even realize it. Anyway,
Absolutely.
I guess I relate. Okay, guys. Well, we only have a little bit of time left, and we're really only halfway through the story, so we're not going to spend as much time on kind of the back half. But let's hear about acquisitions 4 and 5, and specifically now your decision to raise money. Let's do that first. Why was this the moment to raise money from those investors?
Yeah, Will, I think this brings me back to when we met in Dallas at a conference at that time, and we were raising at that time, and so we were at a point where we had a really, really good deal for our fourth deal. It was a white glove freight brokerage and a managed services business, and the managed services business was a totally new line of business for us. So we'd find a really good opportunity. We actually had that in our pipeline. We had another deal that had fallen through. So we had we'd recontacted. We were under LOI when we talked to them. We said, hey, we'll come back to you when we finish the acquisition and when we've integrated it. But we actually made a phone call 3 months later. It was one of the only deals that LOIs that we didn't get to close. So we got 6 LOIs and 5 closes, but it was very opportunistic because the fourth deal was actually a better deal in hindsight for us. And when we looked at that, we agreed a price that was fair, and the structure of that deal required us to max out our SBA. But the cash we needed to bring to close, there was a massive gap there between what us maxing our XBA, going to the max 5 million that you've got available there, and the required cash to close. So we needed to raise, we'd never raised money before, so we certainly went into it relatively green. We went out to the self-funded search community, and it was very interesting. We got incredible feedback from the self-funded search community, and we really adjusted our terms, because I think what we got from that reach out initially was we were focused on how much equity we wanted to give up, and we were focused on us versus focused on the investor and the return that they needed versus other options they had in the market. So it focused us to look inward and really focus from an investor perspective. So that was an incredibly valuable feedback, but we didn't get much traction on what we initially put forward. And the second piece of feedback was the traditional self-funded search market. They were used to dealing with first-time CEOs, and so they had a set of terms that were a little bit more restrictive than we were comfortable with in relation to like stuff that you would want to have control of running the business, given your track record that we had. And some of the terms were of the more sophisticated investors were a little bit restrictive on that side. And then the dilution that they wanted to give up, it was a sizable raise. It was a significant raise on the larger side. So
can you share how much?
It was upwards of 3 million. So it was a significant raise. So that was obviously going to require a number of different parties to come to the table. So we went back after a number of weeks after we talked. We went back and we re-looked at our model, and we put together a very attractive return portfolio for a percentage that we were comfortable with. And we actually went out to our private network. So we had been in Atlanta. I'd been in Atlanta for 10 years. Onu had spent the majority of his life there. We had a significant network in there and an MBA network. So between our personal and professional networks, not friends and family, more on the professional side, our Emory network and the logistics industry, we got about 30% for each of those areas, and raised a full sum with an SBA loan and a seller note and some equity from us that we put in. So it was really a transformational moment for us. And the thing about the money we raised too, we got what I would call smart money. It was very important for us, for the checks that we were taking, that we would be getting value for folks that would be coming in and writing significant checks. So we really were selective in who we went after. So we brought in a logistics focused expert that had done what we were trying to do, that had ran and sold a managed services business. We brought in a former executive from the company I used to work for, who'd done multiple acquisitions, over 1,000 acquisitions in a fragmented space across his career. So this was real value add. Gave up a couple of board seats, but we were really happy to do that, to bring those folks to the table. And actually some larger investors, opted not to have a board seat because we had really good qualified people to do that. And they agreed with that. So, for us, Onu brought up the point at the start, when you go into your professional network and folks that for that, that's just, there's a lot of, for us would be pressure that we're going to deliver there. So we were really happy to be able to give them a really good return and bring folks in on our network. So that all happened quite late. We had a 3.5 month diligence, and it all came in quite late. We pivoted halfway, we adjusted our model, but once we started to get one or two key people in, it flowed well from there. But really only probably one key investor from the self-funded world. The rest of them was private network, Emory, our alumni network, and folks from the space. So really a broad, unique raise for sure.
Mm-hmm. Mm-hmm. And do you think that your first is also your last time raising, or as you continue to grow, you might need to raise again for much bigger acquisitions?
Yeah, you certainly wouldn't rule it out. You wouldn't rule it out at all. We've got a lot of capability within the business. Like we did our most recent fifth deal. It was a refrigerated deal on the West Coast with a couple of former collegiate athletes. So that was a really good fit. And they rolled some equity in and became business partners with us. But we were able to do that all with our balance sheet, we're cash in the balance sheet. So we'll do as much of that as we can. Now we've got growth and scale, but for the right opportunity, you got to be opportunistic in this world. If the right opportunity comes in front that we just feel is an incredibly good fit for our business, we would certainly be open to that. I think we'd be better equipped than we were we signed the LOI and then started to try, and that's not the way to do it, right? We learned quickly within 6-8 weeks of no real progress. We were obviously under a lot of pressure. We've built, but we got it done. I mean, it's like anything with the sports. You got the result, the scores on the board. They don't tell you how the 1-0 was got, right? Or you just see the end. You just see the end score. It could have been under pressure for 90 minutes and got a last minute winner, but that doesn't go down in the history books on the story. But now I think we'd be much better prepared. I think, we've built relationships with folks in the space. We've got a longer track record. I'd be hopeful some of the folks that have been with us on the investor journey would stay with us based on their experience working with us. So we'll certainly we'll be opportunistic when we need to be and do what's best for the business. And if a big deal comes up and we feel it's a good fit and we need some capital, we'd certainly look at that.
How do you guys think about when the timing is right to refinance out of your SBA loan so that you can get out from under the personal guarantee?
That's a great question, Will. I think it's when it's best for the business. Like, you could do it now, but are the terms you're going to get better for the business than what you have? So I think there's an inflection point of when that comes up. And I think if we put what's best for the business first, that will naturally occur. We feel confident that we'll be in a position to do that at some point. But it has to make sense on the cash flows of the business, because if you're putting something on the balance sheet that's takes more cash flows out of the business, that's just going to take away from the returns you can get. But I do believe at some point that opportunity will be there.
Brian, a minute ago you said how the first time you went out to the self-funded search investor world and then didn't raise. And then this time when you went out again for the raise that you did complete, one of whom was from the self-funded search world, there was this shift in perspective. I guess you were kind of empathizing with investors more this time around. Say more about that. What did you learn there? What shifted?
So I think there was a couple of key investors that, when we put forward an initial proposal, turned it down quite quickly, even though they liked us and they liked the deal. And I was just open about getting feedback. I was like, we got on great. You like the deal? How come, and they just said the returns are just they're not compelling enough versus what else I have on my table. And I just unpacked that. And a couple of people were very gracious to give me that feedback. They may not even remember, but it was just, me and Onu were in the office next door, and I would just pop in and say, hey, like, we have to think about this a different way. We have to put the investor hat on and reverse back into the equity that we need to dilute to make it a compelling return. So we totally flipped the apple cart versus focusing on the equity that we wanted to hold on to versus, okay, what return do we need to give the investor that's compelling enough? How do we flip that back into, and then what equity is that worth? It just total 180 degree, but it was really feedback from sophisticated investors in the space that were, gracious enough to give us that direct feedback.
That's great, Brian. And if I could venture some numbers, was this the sort of thing where the first time you went out, you were showing returns to them of, I don't know, 20s, and then that wasn't enough for them because market is higher generally in search land, and this time when you went out, it was more like 30s, and you and Onu say, okay, we need to show that we can deliver our investors, call it 35% IRR. How do we back into that?
I think both of the scenarios were showing good IRRs. It was just different assumptions to get there. So by the time we got to that 35% IRR, it was very conservative assumptions to get there. So you could get a lot more comfortable. And but it required more equity off the top end because of the more conservative nature of those assumptions.
Great. Thank you. Stepping back a little bit, but one thing that we talked about in the pre-call, we still haven't talked about that I think is important, is the quality of the first business, of the platform business. Small though it was, I keep emphasizing its small size, but it was also a really good business, it turned out, correct? And say more, and why did that set you up so nicely?
It was a good business because we understood if there was when we were doing diligence, number one, it was 2.5 years in, and it was good, right? So like we didn't want to extend our search for 3, 4, 5 years, right? So again, timing wise, it was a good fit. We got along well with the seller, and then there was a lot of untapped opportunity within the business that we knew we could extract in short order, right? More specifically, the working capital piece was a big jumping off point to Brian's earlier point. The working capital conversion that we were able to accomplish helped us do the second deal without raising any equity. We just used our balance sheet to do the deal, right?
Okay.
So seeing things like that is really what, piqued our interest and said, hey, this could be a deal that could, take us to that next level, even though it was relatively small.
Great. And that is what you meant when we talked in the pre-call about getting the first deal right.
If we would have done the first deal at that size, and there weren't any real opportunity for us to add value, then we would have been stuck in that area for a while, right? And we knew we didn't want to be at that size for a long time. So we knew we needed to find something that could help us. We can come in, we can add value, and we can organically, either grow the business or convert the working capital into cash on a balance sheet to do the next thing.
So guys, net it out for us again, the trajectory here. Well, and I'll start. So you're now 70 employees, 5 acquisitions, revenue of your first acquisition. I don't think we knew you bought it for $1.5 million, but I don't think we heard revenue of that first business.
It was about 4.5 mil.
Yeah, just under
revenue.
5. Well, yeah.
Just under 5 million in revenue. In revenue today,
Close to the size of the employees.
Yeah.
What's that?
Close to the size of employees. So in the freight world, a person per million in revenue is usually good angle. So when we started, we had just under 5 million revenue with 5 people, and with close to 70 people, we're pretty close to that on the revenue side. So it's usually a person per million in revenue, and it's an old metric that carries well in over the test of time.
Great. And are there any rules of thumb related to margins in this world?
So, with being a brokerage, the margins in the space with the bigger competitors are mid to high single digits, more on the mid single digit EBITDA dynamic. We've got a niche group of businesses, so we would operate at our size ahead of those bigger guys in the space. But that's typical for the space.
Well, that's remarkable, guys. And so how do you think about the future? Are you guys building indefinitely? Are you building to a particular number? You don't know. You'll consider options as they come.
We're having way too much fun right now. So we're just building. I use this saying all the time. We're chopping a lot of wood, and we're just chopping. We're chopping. And like I said earlier, it's as we get to the next level, there are different challenges, and man, that's just incredibly fun for me and Brian. So as far as like what's the next thing, we want to build a really good business, right? A really good business that we can be proud of. Our employees can be proud of. Our investors can be proud of. Like that's really the big focus for us right now.
Yeah, lots of opportunities still out there, Will, and Onu made the point. We're enjoying it a lot more now that you've got scale and you've got a lot more people. You've got a lot more scale. So I think we've got a long runway here, and really enjoying the process. And it's nice to have a team of people where you can focus more on the business and on those strategic initiatives to really help drive the business forward. Because for those initial years, we were in the business on a daily basis. So it's really nice to be able to step out and work on the business and all those important strategic priorities that are going to drive the business forward.
You said earlier how your inorganic acquisitions, your inorganic growth, your acquisitions were about kind of filling out the portfolio of offerings to your customers. Are you done? And is there any part of you that is interested in continuing to acquire for growth's sake as opposed to having new offerings?
Yeah, it's That's a very good question. And we're always looking for, like, anytime we get a deal across our desk, like the ones that really pique our interest are the ones that have a niche offering, right? So we're going to continue, looking at those offerings. And again, we've always been opportunistic. So if there is an opportunity that is closely aligned with one of our current offerings, then we may do that deal. But we always look for other segments of the space where we can add to our portfolio, so we can continue cross-selling within our customer base.
And does growth with excellence and the intensity that you guys are treating your business, does organic growth, is that pretty much, I don't want to say happen naturally, but is there a good path to a lot of growth purely organically here?
Yeah, 100%. I mean, we have a very functioning sales engine here. We have a pretty good sales team. And for us, we like going after small to medium sized businesses, because as those businesses grow, we grow with them. So like that's also a key strategy for us is latching on to the right partners that are growth seeking like we are. And oftentimes as they experience growth, we also grow as well.
Great, guys. Last question. As you reflect on how you built this, going from a smaller acquisition with an SBA loan, still have the SBA loan, maxed it out, brought in other equity as we've covered. Would you suggest that format of building a roll-up like you've built to other searchers? Do you feel like it was a good way to approach that, and you think it's a formula that those listening might follow?
So I think it worked for us well, and I think each searcher will have their own unique dynamics and set of goals. So I think each searcher's got to assess what their motivations were and are at the start and what's important to them. For us, it was really important to have full control of the equity and to build a track record. And very fortunate to have a great partner to run with and run at speed. Certainly doing this on your own at the speed that I certainly could not have done it on my own at this speed, at this velocity. There's just so much ground to cover. So I think if folks are thinking about a roll up at this scale, you just want to have the right team around you, and you want to be very confident in how much that's going to take. But I think each path is unique to the individual searcher or searchers. But for us, it's been a very compelling journey. It's gone well for 4.5 years overall. It's gone great. But certainly there's been many challenges on the way, and you don't want to underestimate that how difficult entrepreneurship is. It challenges every skill set that you have and makes you develop others. And it's very rewarding. They say hard times make strong people. It's true. Yeah, it is definitely true. Certainly feel just a lot more seasoned and experienced having come out of the at this point in the journey.
Onu, any final thoughts?
I mean, I would echo what Brian just said. We've grown a lot over the last 4.5 years, and it's the people around you, right? If you have good people that are equally as dedicated to the mission, I mean, that's half the battle, right? And we have been able to cover a ton of ground, because I believe it's me and Brian, like we have our areas of expertise, and we really lean into those expertise. So I think we've been able to run and cover a lot of ground because of the partnership. So my recommendation to future searchers or whatever the case may be, it really all depends on how far you want to go. Like if you want to buy a small business and keep it relatively small, you get a good lifestyle, and great. But if you want to grow something of massive size, then I think you have to arm yourself with the right people around you. And I'll end with this: is don't go into it, if you are going to partner, don't go into it with just a buddy. Like, hey, I know this guy, he's my buddy. We have, a great time at the bars, whatever the case may be. Find somebody that complements your skill set, right? So like for instance, like Brian, like one of the best CFOs that I've come to know, right? So like he's been able to drive that piece of the business, like drive the acquisition piece of the business. So it's you want to find somebody to partner with that complements your skills to help you guys cover a lot more ground. Rome was built in a day, but it wasn't built by one person. It's always a team effort.
Excellent. Guys, congratulations on how far you've come, what you've built so far. Look forward to seeing where you continue to take it. Brian Boland, Onu Okebie, thank you very much for joining me.
Thanks, Will. Thanks for having us.
Thanks, Will. It's a pleasure.
Hope you enjoyed that interview. Don't forget to subscribe to the Acquiring Minds newsletter. We send an email for every episode with an introduction to the interview, a link to the video version on YouTube, and soon, key takeaways, numbers, and more essentials from the interview for those of you who don't have time to listen or watch it. Subscribe at acquiringminds.co. You'll also find all our webinars there on the website, both those we have coming up and recordings of past webinars. At this point, there are over 30 webinar recordings, a wealth of information on all the technical nitty-gritty of buying a business. acquiringminds.co.